Hello, everyone, and welcome to a Wall Street Radar Extra. I'm RakeM, your host. About 4 years ago, I put out a video about buying back bonds from bankrupt companies, canceling those bonds, and then reaping huge profits in the process. Using that strategy, you could easily reach a net worth of $100 billion within the first 2 weeks of a game. But that was way back in the before times using version 7.83. A lot's changed in the last 4 years with 16 new updates and changes to just about every aspect of the game's behavior. Many people have pointed out in the comments that the bond cancellation strategy just doesn't work in version 9.0. So I took a look at it and I have to admit that they're absolutely right. It no longer works. But I also found out that it still kind of works. Let's check it out.
Lack of a better word, is good. Greed is right. Greed works.
When you start a new game of Wall Street Radar, the database is randomized in a variety of ways based on the difficulty level that you select. First, the indexes are randomized, which includes the prime interest rate and the monetary policy, the commodity prices, the industry supply-demand conditions, and the GDP growth rate. Then each entity in the game is initialized regarding their assets, the amount of debt that they're carrying, and their management settings. It's worth noting that the higher the difficulty, the more debt there is overall. This is why you'll find more companies in bankruptcy when playing level 3 and 4 versus the lower difficulty levels. In version 7.83 on difficulty level 3, you would typically see in the neighborhood of 20 companies with a D credit rating. In version 9, however, this number is cut in half. After running 10 games at each difficulty level, it's clear to see that the randomization has changed regarding how many D-rated companies exist at the outset of a new game. And this is why the bond buyback strategy doesn't work as I presented it 4 years ago. There's just too few affordable D-rated companies at the beginning of a game. The good news is that the bond cancellation strategy still works if you change how you select your targets. It takes a little longer to do it in version 9 than in that you make less per transaction, and it requires some specific game conditions, but it still works. Here's a game where I use this strategy, and on February 3rd, my net worth is $86 billion. And here's another one where I have $118 billion on January 25th. And here's yet another game where I have $89 billion on January 29th. And I achieved these results using the same buyback and cancellation strategy as before, but rather than target D-rated companies, I'm targeting companies whose debt is primarily bonds where those bonds are trading at a significant discount. In Wall Street Radar, as in the real world, bond prices are largely determined by the prime rate. When the prime rate is low, bond prices are high and vice versa. Another factor is the credit rating of the issuing company. The worse the company's credit, the less the bonds are worth. So, to get the most out of the strategy at the beginning of a game, we need market conditions that result in a depressed bond market. To be specific, we need a prime rate of 9% or higher. Ideally, we would like a monetary policy to be heightening in combination with an already high prime rate, but if the policy is neutral, that's fine too. If you get a prime rate above 11%, you can employ the strategy no matter what the policy is. Just keep in mind that the policy is an indicator for what the prime rate is going to do in the future. So if you have an easing policy, your window for using this strategy will be limited. To give you an idea of how rare or common these favorable conditions are, I ran 40 new games at the different difficulty ratings. On average, a prime rate of 9% or higher occurred in 20% of the games, or 1 out of 5 games. A double-digit interest rate was seen in 7% of the games. As for the policy, 75% of games had an easing policy. A neutral policy occurred 15% of the time, while a tightening policy occurred in just 10% of games. This means you'll more than likely be restarting your game a few times before you get the proper conditions for this strategy. And if you want to go for the holy grail of a double-digit prime rate coupled with a tightening policy, be prepared to restart a lot. That combination is only seen in 0.75% of games, or 1 out of every 133 games. Okay, you've started a new game and the prime rate is above 9%. How does this strategy work? Just as before, you're making your profit off of the discounted bonds. Let's use Organogenesis here as an example. It has a net worth of $352 million and $401 million in bonds at a price of $45.85 each. This means we can buy the bonds for roughly $184 million. That's a discount off the face value of $217 million. Now that $217 million represents more than half of what this company is currently worth. So if we buy this stock and its bonds and then cancel the bonds, this company will benefit in 3 ways. First, it will show an extraordinary income in the amount of the bond discount. Second, its credit rating will vault upwards because the bonds will have been eliminated. And finally, since the bonds no longer exist, the interest payments that they were previously paying out on those bonds, those are eliminated too, boosting their quarterly profit. If we then have the company issue new stock, the proceeds from that will also improve the credit rating, which has a positive effect on the company's stock price. Now, before I get into demonstrating how this is done, I just want to prepare any of you who came here after watching the Starting Strategies video from 4 years ago. In version 9, you aren't going to triple your money on a single trade with this strategy. It doesn't work quite as well as it used to. A typical return on one company, on turning over one company, is somewhere in the 20 to 30% range. There are some exceptions where you'll do better. There's even some where you'll do worse. But more often than not, you're going to make some sort of profit so long as you stay within the ranges I'm going to specify here shortly. But 20 to 30% is not bad. I mean, if you make 20% a day, every day for your first month of game time, you'll have $284 billion by the end of the first month. So, you know, it's the best thing that I've found for creating wealth at the beginning of a game, even with how it compares to what the game was like 4 years ago. From a practical standpoint, 100 billion in the first month is a reachable goal. Even with the ticker paused, you're going to lose a day here and there as you do your research. And once you get to around 40 billion, there'll be fewer companies for you to target. The highest number of bonds any one company will carry is around 45 billion. And there's only a couple dozen of those at the beginning of a game. And most of those will have great credit. So for all of those reasons, 100 billion is usually my goal for the first month of a game. All right, so let's get into the nuts and bolts of this thing. You've started a new game and the prime rate is above 9%. And I have a game here where the prime rate is 10.75 and the policy is easing. Now that means the prime rate could drop at any time. So I've paused the ticker in order to do as many of these trades as I can before that happens. So once you've got the ticker paused, you'll go to the database search to find a company to target. But since I've already got Organogenesis identified, I'll show you that part on the next one. Those 3 things that you want to look for when targeting a stock. The first is what we've already talked about, the ratio between the bond discount and the company's net worth. Specifically, the discount needs to be at least 30% of the net worth or more. Anything less than 30% and you're going to have trouble making a profit because you're going to be paying a premium on buying the stock, and you need that ratio to be big enough to where you can make that premium back. The second thing you're going to be looking for is that the stock is 100% public. If any corporation owns the stock, just skip it and move on. You're going to have to pay too much of a premium on the stock. That's going to eat into your profit. The one exception is that if the existing holder is an ETF, an exchange traded fund. If that's the case, normally they will accept an 18% markup to sell off their shares, which is less than the 19 or 20% that you're going to spend buying it from the public when you do the tender offer. So if it's an ETF that holds the stock and generally those only hold 10% or less, it's okay to go forward. But if it's a bank, an insurance company, or another industrial company, just skip that target and move on, find a better one. The third and final criteria for targeting a stock is that the stock price to net worth ratio needs to be 140% or less. Anything above 150% is going to eat into your profits. If you try this with a stock that's trading at double or more of its net worth, you're going to lose money on it. But anything under 140% is fine. Even if it's trading at less than its net worth, that's fine. Just don't go above 140. Organogenesis here is trading at 134% of its net worth, and its bond discount to net worth ratio is 61%. So it ticks all the boxes. Now it is partially owned by some ETFs or an ETF. So I have to buy that stock away from the ETF so I can contribute the bonds back to the company. But I'm going to only offer 18%, an 18% markup to get those shares, and it should accept it. I've had ETFs accept bids or offers as low as 16%, but since time is of the essence and I don't want to have to make multiple offers, when I'm doing this strategy, I typically offer 18%. If that's usually accepted, and it is, if it's not, I will offer 19, and if it doesn't take that, I just move on because that's cutting into my profits. All right, now I'm not smart enough to do all the math in my head, so I use a spreadsheet, and we'll check that out at the end of the video, and I'll show you how I use it on the next one as well. So once you've identified a target, the first thing you're going to do is you're going to buy the bonds. The price went up here a little bit, but that's fine. It was just a small bump, so let's go ahead and go get them. Next, we buy the stock, and 6% of this stock is owned by an ETF. So we'll make an offer of 18% to get those shares, which, like I said, is actually lower than what you'd spend buying it from the public. And I can't stress this enough. If this 6% was owned by any other kind of corporation, I wouldn't be doing this. Now we contribute the bonds back to the company in order to cancel the bonds. Next, we have the company issue new stock through a public offering. And finally, we sell off the stock. We made a profit of $207 million for a 28% gain. Okay, now let's do a database search. I have the market cap range set from 1 million to my net worth, and as my net worth goes up, I'll set the bottom end to half of my net worth. I have a credit rating checked so that my results are sorted by the credit rating. That's a new feature of version 9. And I have the minimum credit rating set to D, so it shows me companies of all credit ratings. Has bond is checked for obvious reasons, and I should filter out any stocks that are trading too high by putting 140 in the box here. We've got 45 results, and what I'm looking for is the biggest bond discount. So estimating the number of bonds by the bond price to figure out which of these has the biggest discount in terms of dollars. We then have to select one in order to see their net worth and find out if the discount is big enough in relation to the company's net worth. Now, as I'm looking through this list, I'm typically ignoring any of these that are trading above 70. I mean, unless the company is C or D rated, the discounts on those aren't going to be big enough in relation to their net worth. And even on C and D rated ones, it's rare that they will be big enough. Novellus here has a good bond price, but only 154 bonds. And Pittston has the same price and double the bonds, but I like Ensco down here even better. Nearly 600 bonds and the price is only slightly higher. Cablevision looks pretty good too, but let's go ahead and do Ensco. All right, so first I check to see if the stock is 100% public, and it is. Now let's do our math. It's trading at less than what it's worth, so that's fine. And its bond discount is 45% of its net worth. So this one's good to go. And the steps are the same every time. You buy the bonds, you buy the stock, contribute the bonds, issue a stock offering, and finally you sell the stock. This time we showed a profit of 66% for 602 million. And honestly, they're not usually this good. Mid to high 20s is usually what I see. Okay, let's go back to the database search. And what was that one? Cablevision. Okay, it's 100% public, so let's do the math. Its stock price is good, and the discount is 54%, so this one's a go. Again, we buy the bonds, we buy the stock, we contribute the bonds, we issue a public stock offering, and then we sell the stock. At this time, we only made 111 million for a 12% bump. And the discount on that one was huge, so I'm not sure why we didn't make more, but it's not a big deal. I'm not going to take the time to go figure that out. Still making a profit, so it's fine, and I just move on to the next one. All right, so we're going to increase our limits here to get a little bit bigger fish. And here we go, Dillard's. It's 100% public. The net worth and bond discount are both good, so let's get it. This is more like it, 27.3% return for 818 million. All right, let's do a couple more and then we'll take a look at the spreadsheet. Hormel maybe? Oh, but Territorial Oil is twice as big. This one has a better price though. But he's not 100% public. Both of these are ETFs, but You know, that is, so I mean, that'd be fine, but let's just go back. What was it? Potlatch? Yeah. Or Campbell soup, maybe. Oh, but this one's better. Kearny and Trecker. And he's public. All right, let's run the numbers. Okay, this one checks out. His net worth is a little low, but it should be fine. Or I mean, his stock price is a little low, but it should be fine. And we gained 375 million on that one for about 10%. All right, one more, and let's look at Hormel. Okay, his bond discount is only 22% of his net worth, and that's a deal breaker. Let's go back, find another one. All right, got Guidewire. Guidewire here looks great. Let's take a look. And it's 34%. Let's get it. Profit of 540 million for almost 10% as a return. Okay, so we've done 6 trades in 6 days, and we've gone from 1 billion to 3.5 billion. And it's just rinse and repeat at this point to get to 100 billion by the end of the month. And just when you do your database search, just keep bumping up the market cap limit as you move up the ladder. And that's pretty much it. Let's take a quick look at the spreadsheet, and I'll highlight the calculated fields so that you can recreate these formulas on your own. But if you would like a copy of my spreadsheet, just send me an email at the address on your screen or in the description, and I'll be happy to send you a copy. Okay, so the first calculation is based on the net worth per share and the price per share. It's a straight division of the price by the net worth. Anything over 140% in this column, and the stock's not worth buying. We calculate the amount of the discount by multiplying the bond price by the number of bonds and subtracting that figure from the face value of the bonds. Then we divide the discount by the net worth to get the ratio. If the ratio is less than 30%, don't buy it. And that's pretty much it. Now, all the stuff over to the right of me keeping track of the profit is just trying to see if there's any correlation between the amount of the bond discount and the amount of profit realized as a result of the trade. And as you can see, there's not really much correlation. So there's some more stuff going on behind the scenes that I haven't quite figured out yet, and not sure that I'm going to bother to try, because there's so many different factors that go into determining a stock's price. And it's so convoluted and complicated that even at this point, I'm not sure anyone knows how to like reverse engineer a stock price. But anyway, so I mentioned earlier, one last thing I want to tell you. I mentioned earlier that it is possible to break even or lose money on a single transaction, even when you follow this recipe to the letter. And I should probably clarify exactly how often that is. So out of 60 or so trades that I have tracked while using this strategy, only 3 didn't show a profit. The first one, I had a 9% loss, and that's because I bought a stock and did this when the stock to the price to net worth ratio was 185%. And I just wasn't paying attention. I had bought this stock even though it was high, and I lost 9% on it. So that was the explanation for that one. The other 2 where I lost money, they were within all the ranges that I specify here, and yet I either made or lost about 1% of my investment. And I didn't go back to try to reverse engineer why that was. I just assumed that the industry conditions for both of those were probably terrible. And this is just assumptions on my part, by the way, that the industry conditions were terrible. Market conditions were deteriorating, that both of these companies probably had negative projections. And interestingly enough, both of them were trading at less than their net worth when I bought them. But 1% plus or minus, I consider that a break even. So it's really not a factor to consider when thinking about this in terms of risk, right? So you just break even and you move on to the next one, because there's so many here. You really can't go wrong. As long as your interest rate is above 9%, you're going to make money pretty much on every one of these. But I just wanted to say, it's possible to lose money, a little bit of money on a single trade, but it's pretty rare. If you follow the recipe as I've laid it out in this video, a small loss isn't going to hurt too much if it happens at all. All right, so that's pretty much it. It's fairly simple. If you do have any questions, though, feel free to leave me a comment below. I'd be happy to answer your questions. And again, if you want a copy of the spreadsheet, just email me at flipnotchannel@gmail.com. I'll be happy to send you a copy. All right, but that's it for today. Thank you for joining me. I hope you enjoyed it. If you did, please like and share. And until next time, this is RakeM saying, have a good one.